Yeah, I think we can now start. We can now start. We can now start. We can start. We can start. We can start. We can now start. Let me share this link with them. Yes, good evening once again. So today we are looking at goodwill for sole traders and partnerships, though we are going to put more focus on partnerships. So that's our subtopic for today. We are still looking at partnership accounts. So partnership still continues, but today we look at goodwill for sole traders and partnerships. That's what we are looking at today. We'll look at the learning objectives. You'll see that after you've studied this chapter, you should be able to explain why goodwill exists. You should also be able to calculate adjustments needed when there is some form of change in the partnership. Basically, we are going to be looking at the changes in the partnership business. That's what we are going to be looking at. How do we deal with those changes in the partnership business? We start with goodwill. First, we need to know what goodwill is. Now we talk about goodwill. Goodwill is an intangible asset. Goodwill is an intangible asset. You cannot touch it, so it has no physical substance. This goodwill can only exist if the business was purchased at an amount and the amount paid was greater than the value of the net assets. Then in such a scenario, goodwill arises. So just look at a business which has been acquired, assuming the cash paid is 1.2 billions, but the net worth or the net assets worth of the business they have acquired, let's say it's 1 billion. So there is some excess of 0.2 billions. That excess is what we call goodwill. So goodwill is an asset. It can only exist if the business was at the value of the net assets. So if you pay 1.2 billions, but the net assets are worth 1 billion, it means that that excess of what we refer to as goodwill. In many cases, goodwill I'm struggling to get it, please. I don't know what you're struggling to get, Richard, but we are looking at a scenario whereby a business is acquired or a business is purchased, but then you find that the amount that has been paid is greater than the value of the net assets. So net assets, we are looking at the worth of that business. That is when we compare all its assets and all its liabilities and all its resources. So it's network breaking up, but now it's clear. Okay, I was off because of the network. So that is goodwill. Normally, it will exist if the business was purchased and the amount paid was greater than the value of the net, greater than the value of the net assets. My network issue. Okay. So in many cases, goodwill represents the value of the reputation of the business at the time it was purchased. We have different reasons for payment of goodwill. What do you think are the reasons as to why goodwill is paid for? Reasons for goodwill payments. What are some of those reasons? Alex, Patricia, Susan, what are the reasons for the payment of goodwill? Which reasons call for the payment for goodwill? Yes, reasons for the Alex, you're not clear. Members, reasons for the payment of goodwill, Kathy, Christine, Garang, Grace. Why do business, assuming you're purchasing a business which has already been in existence, or which is in existence, why do you have to pay for goodwill? What are some of the factors giving rise to goodwill? Yes. What are some of those factors for the payment of goodwill? Any idea? Why do we have to pay for goodwill when we are purchasing a business that has been in existence? Caleb, Yvonne, why do you have to pay for goodwill?
So to me, it's like it has already established its customers, so it is easier to retain them than a business that has not been there before.
That is Vivian. Vivian is talking about the customers. Then Susan is talking about the reputation and the brand value. Thank you. Then what else? What else? What else apart from the customers and the reputation? What else? Yes, Kathy, you can say something. Kathy is on YouTube. Yes, you can say something, Kathy. Yes. You can type. You can type. I'll read your message, Kathy. Then which other points? Which other reasons? For insurance claims. Okay. When you look at the notes, you'll see that in buying an existing business, which has been established for some time, there may be quite a few possible advantages, provide strong competitive advantage, making competitors to replicate. Okay, thank you, Susan. So these are some of the reasons why businesses, as to why if you're buying an existing business, you have to pay for goodwill. Catherine on YouTube, she's saying that because the business already has established its name. Yes, thanks, Kathy. So these are some of the reasons as to why you may end up paying for goodwill if you're buying an existing business. Number one, a large number of regular customers who will continue to deal with the new owner. So if I'm the new owner and I'm buying your business, we expect a large number of customers to continue to deal with you, the new owner, meaning that we have to also incorporate that as we are selling our business to you. So you have to pay some excess because of a large number of regular customers, access to new markets, Grace Namkasa. then the business has a good reputation. If the business has a good reputation, then you'll find that you have to pay some goodwill has been established. It has that good reputation. It has experienced efficient and reliable employees. Yes, we have to consider the employees. If they are experienced, they are efficient, they're reliable, then we also have to consider them. The business is still in a good location. So if the business is strategically located, of course, there will be some goodwill into there will be some goodwill as you're purchasing that business. It has good contacts with the suppliers, yes. It has a well-known brand names that have not been valued and included as assets. So these are some of the reasons for the payment of goodwill and many others. Okay. Now you'll find that these advantages are not available to those businesses that are new. If the business is new, then we don't expect to see these advantages. These advantages come in, the business has been in existence. The business has been in existence. So for this reason, many people are willing to pay an additional amount for goodwill when they buy an existing business. So because of these different reasons, you'll find that if someone is buying an existing business, then they have to pay some additional amount for goodwill. Now, what happens in the partnership books? Do we have to account for goodwill when we are disposing of the partnership? Oh, let us see. Why do we have to look at goodwill under the partnership accounts? Although goodwill is not normally entered in the financial, it boosts business expansion. Thank you. Although goodwill is not normally entered in the financial statements, unless it has been purchased, sometimes it's going to be necessary where partnership. And normally goodwill comes in, maybe if we are selling off the business, but under partnerships, you'll find that we have to bring in the goodwill whenever we have partnerships. Why? Unless it has been agreed differently, partners own a share in the goodwill in the same ratio in which they share profits. So if we start up our partnership business, it's going to be in operation. We are going to make profits. We are going to make a name for our business. So there is goodwill that is created. So that goodwill has to be shared. So we all have a share. The partners will be having a share in that goodwill for the partnership. So for instance, if A takes 1/4 of the profits, it means that A will be the owner of 1/4 of the goodwill. So that goodwill for the partnership has to be shared as well among the partners. This is true even if there is no goodwill account. So however much we don't have goodwill in the books of accounts of the partnership, just know that if that partnership has been in operation, then there is that goodwill. There is that goodwill, and that goodwill has to be shared by those partners, the business. This means that when something happens such as the existing partners decide to change profit and loss sharing ratios, a new partner is introduced, a partner retires or dies, then the ownership of goodwill by the partner changes in some way. So whenever we have these, then we introduce goodwill into the partnership books. Goodwill comes in when the new partner is introduced. Assuming we are admitting a new partner, then we have to account for goodwill. When existing partners decide to change the profit and loss sharing ratios, then we have to introduce goodwill in the partnership books. Then when a partner retires or dies, then we have to also introduce goodwill in the partnership books. These are the circumstances under which we introduce goodwill in the books of the partnership. When a new partner is being admitted, a partner retires or dies, or when there is a change in profit or loss sharing ratios. The change may involve cash passing from one partner to another, or an adjustment in the books so that the changes in ownership do not lead to a partner giving away their share of ownership for nothing. So sometimes cash may be involved. That is, cash can be passed from one partner to another to ensure that you don't give out your share of ownership for nothing. Change in profit sharing ratios of existing partners. When can we change ratios in the partnership? The profit sharing ratios. When can the existing partners change these ratios? Under what circumstances can the ratios be changed? Under what circumstances can we change the profit or loss sharing ratios? Catherine and the team on YouTube, when do we change the profit sharing ratios? Under what circumstances do we change these ratios? Patricia, Kathy, Christine, Grace, Richard, Alex, Vivian, Caleb, when do we change these ratios? Under what circumstances can the partners change the ratios? Yes. When can these ratios be changed? Or they have to, or they just have to be constant, no need of changing them. They can change, but when do they change? Yes, any idea on when we should change the ratios?
It could be under the circumstances in which a partner may not be performing as of before.
Okay.
So what if for the partners change, like the capital they contribute? Could it be the reason why that would happen?
When they introduce in more capital? No, when they introduce in more capital,
No, when they change the capital contribution.
When they change the capital contributions,
Yes, sir.
Someone song about capital contribution. Then Catherine, her point is that when one partner dies or unable to work anymore, yes. When one can't deliver a service, okay. So the ratios will change. The ratios will change sometimes, and these are some of the reasons why these ratios may change. Number one, a partner may not work as much as in the past, possibly because of the old age, because of ill health. So we have to change the ratios. If they cannot work, additional work delivery, okay. So a partner may not work as much as in the past. So that may be because of the old age or ill health. And in such a case, you may find that we have to adjust our ratios. We have to adjust our ratios. Christine, maybe decline in performance. Yes, that can also be maybe the partner's performance is not as expected or is not as before. Then we can change our ratios. The partner's skills and ability may have changed, perhaps after attending a course or following an illness. Now, assuming you've completed your degree, now you have more skills. You have skills in marketing, you have skills in IT, you have skills in accounting. Now, we see you as someone who is resourceful. So we can say, okay, let us alter our ratios because of that. Or when a partner is ill, okay, following an illness, sometimes we can also change our ratios. A partner may now be doing much more for the business than in the past. Yes, partner may now be doing much more for the business than in the past. So it can either be, it's two-way. Either the performance is declining or the performance has now increased. So under all these, we can change our ratios. Okay, we can change our ratios in case of any of these situations. Now, we have to introduce goodwill whenever we have all these changes. When the ratios are changed, when we admit a new partner, when a new partner retires, you'll find that we have to introduce goodwill. We have to make some adjustments for goodwill. Christine, Catherine is saying that I mostly see those ratios displayed differently, 1 to 3. One of the procedures to do so will depend on the agreement of the partnership. Remember, initially they have to come up with an agreement. So in the agreement, they agree on how they are going to be sharing their on how they are going to be sharing their profits or losses. So it will be as per the agreement, Catherine. Now, goodwill. Which adjustments do you make whenever you're introducing goodwill? Now, the adjustments to be made when accounting for goodwill, there are 2 adjustments that we can make, or there are 2 methods of accounting for goodwill. One of the methods is the revaluation method. Revaluation method. Under the revaluation method, the goodwill account is opened. The goodwill account is opened, and when the goodwill account is opened, we make the following entries. We debit goodwill account with the total value of goodwill, and then we credit the partner's capital accounts, each one with his share of goodwill in the old profit sharing ratios. I've told you that the partners have a share in the goodwill. Okay, the partners have a share in the goodwill. So to report goodwill, we debit the goodwill account, and then we credit the partners' capital accounts, each one with his share of goodwill according to their ratios. That is under the revaluation method. So under that method, you'll find that goodwill is to be maintained in the books of the partnership business. This is something which is also very important. Under the goodwill account opened, or under the revaluation method, the goodwill account is prepared, and then the value of goodwill is to be maintained in the books of accounts. Then the other method is known as the memorandum revaluation method. That is method 2. Memorandum revaluation method. Under the memorandum revaluation method, you will find that the goodwill account not opened, in brackets, memorandum revaluation method. So here the point is, yes, we open up the goodwill account, but the goodwill is written off immediately. The value of goodwill has to be written off. The value of goodwill has to be written off immediately. In other words, here we don't maintain that goodwill in the books of the partnership business. So what we do, we open a goodwill account, then make the following entries. We debit goodwill account with the total value of goodwill. Then we have to credit the partners' capital accounts, each one with his share of goodwill, all the profit sharing ratios. We are going to see how to do this. And then we have to write off that goodwill. So you see these entries here are the same as these are. They are the same. So we open up the goodwill account, and then we debit to the goodwill with the total value of goodwill, and then you credit our partners' capital accounts with their shares of goodwill. But now under the memorandum revaluation method, the goodwill has to be eliminated, or it has to be written off. How do you write it off? You debit the partners' capital accounts, each one with his share of goodwill in the new ratios. So as we are writing it off, we use the new ratios. Then as we are sharing it, we use the old ratios. Write it off, you will be debiting the goodwill account. You will be debiting the partners' capital accounts, each one with his share of goodwill in the new profit sharing ratios. And then you credit the goodwill account with the total value of goodwill. I will illustrate how to do this. Still on my YouTube channel there. work questions for the use of these two methods, the random revaluation method as well as the revaluation method. Now, under the random revaluation method, the goodwill is not maintained in the books of partnership. The goodwill is not maintained in the books of partnership business. So we have to write it off. So that's goodwill. It will depend on the method which the partnership is using. If they are using revaluation method, then goodwill has to appear in the books. It has to be maintained in the books. If they're using the random revaluation method, then we have to write it off. So in the questions, they will always specify the method that is going to be used to account for goodwill. Admission of new partners. Now, what if we are admitting a new partner? What happens on admission of a new partner? On admission of a new partner, of course, there are different reasons as to why we may admit a new partner. Sometimes you find that as an extra partner, either because the firm has grown or because someone is needed with different skills. So you can join the partnership simply because maybe they need an extra partner because of the expansion in the size of the business. So they need some more partners. So we can add in more partners simply because of the expansion in the size of the business. Or you may find that we need someone with new skills, so we can add in it as well. Then to replace partners who are leaving the firm. This might be because of retirement or death of the partner. You may find that one partner is leaving, that then the other partner is coming in. If that is the case, then we can admit. So if there is someone who is leaving, then you may find that we have to replace that partner. Or in case of death, we have to replace that partner. So a partner may be admitted, usually one of the two reasons. Either because the firm has grown or because someone is needed with different skills, or to replace a partner who is leaving, or a partner who is retiring, or replace a partner because of death. Now, when a new partner is admitted, that new partner pays some cash for his or her capital contribution. That new partner will pay some cash for his or her capital contribution. And to record that cash that is paid by a partner who is being admitted, we have to debit the cash of bank, and then we credit that partner's capital account. We credit that partner's capital, we credit that partner's capital account. So that's what you do when you're admitting a new partner, and that partner is paying in some cash for capital contribution. We record that in the business's cash or bank account, and then you credit that partner's capital account. Now, when we change ratios, when we admit a new partner, or when an old partner is retiring, or in case of death, assets have to be revalued. Revaluation of partnership assets. Assets will have to be revalued whenever there is a partner who is being admitted, whenever there is a partner who is retiring, or whenever there is a change in profit and loss sharing ratios. The assets of the partnership have to be revalued. Why do we revalue these assets? Need for revaluation. That when a business is sold and the sales price of the assets differ from their book values, there will be a profit or loss on the sale. That profit or loss will be shared between the partners in their profit and loss sharing ratio. This sharing of profits and losses on changing assets values does not just need to be done when the partnership is sold. So we don't need to revalue assets when the partnership is being sold, no. But whenever a new partner is being admitted, whenever a partner leaves, when there is a change in profit and loss sharing ratios, then the partnership assets have to be revalued. The partnership assets have to be revalued. So as no sale has taken place in any of these circumstances, the assets will have to be revalued just to reflect what they are worth at the date when the changes occur. So any gain or loss as a result of revaluation, that gain has to be identified and accounted for. Okay? The gain has to be identified and accounted for. By revaluation of assets, you may now be stuck. What is revaluation? Now, revaluation of assets, this is all about the process of adjusting the value of an asset. Okay? You adjust the value of the asset to reflect its current marketing value, assuming the asset was acquired some years back. Do you think its value by that time will still be the same value as of today? Of course, no. Why? Because there are always changes in the market. So we have to come up with a new value of that asset. So the revaluation, I'm referring to the process of adjusting the value of an asset such that now we reflect the current market value of that asset. As we are valuing the assets, their valuation should reflect the current market value. So if the asset was acquired some years back, now we have to revalue it such that our financial statements reflect its current marketing, So you can either revalue upwards or you can revalue downwards. We can revalue upwards or we can revalue downwards depending on the results of revaluation. So once assets have been revalued, you need to record the changes and gains and losses in the ledger accounts of the partnership. So when assets are revalued, we need to record the changes and gains and losses in the ledger accounts of the partnership. So how would we account for the revaluation of assets in the partnership books? The first account you have to open is what we call a revaluation account. So we open up a revaluation account first. So whenever you see that assets have been revalued, the first thing you do upon revaluing partnership assets is to open up a revaluation account and make the appropriate entries. So the values of assets may go up or may go down depending on your revaluation results. So for each asset showing a gain on revaluation, if the asset has been revalued upwards, then we have to debit the asset account with the gain, then we credit the revaluation account. So check and see if there is a gain on revaluation. If it's a gain on revaluation, then we debit the asset account with the gain, and then we credit the revaluation account with the gain of an asset, with a gain in the value of the asset. Then what if it's a loss? Because sometimes you revalue the assets and you come up with a loss. So if it's a loss, then we have to debit revaluation account and then credit the asset account. The revaluation account and then credit the asset account. The asset has been revalued, but with a loss, we do the reverse gains. But if there's an increase in the total value of assets, debit profit to revaluation account, and then you credit the old partners' capital accounts in their old profit and loss sharing ratios. So whenever there is revaluation of assets and we have a profit or a loss, that profit or loss is shared by all. So if you are admitting a new partner, then that new partner is not entitled to a share in the profit or loss revaluation of assets. But there is a star on this point. If there is a fall in the total valuation of assets, we have to debit the old partners' capital accounts in the old profit and loss sharing ratio, and then we credit the loss to the revaluation account. There is a note that if the current accounts are kept for the partners, the entries should be made in their current accounts. Last time I talked about the current accounts and the capital accounts, and I told you that the capital account is strictly for recording the capital contributions of the partners. Things like profit shares, salaries, interest on drawings, those ones we take them to the current accounts. So the current accounts will be recording the shares in profits or the shares in losses. So when assets are revalued and we have a profit or loss on total valuation of the assets, we take them to the current account. If it is kept, if it's not kept, that's when we take them to the partner's capital account. So you need to know what goes to the capital account and then what goes to the current account. Current account records those shares, profit or loss shares, the salaries, the interest on drawings, those ones we enter them in the current, account. So the current account is not maintained, then that's when you can use the capital. That's when you can use the capital account. So that is goodwill and revaluation of assets. Now what we have to do, we are going to go through this question together. This question is in the notes. The question is in the notes. Those without the notes, I've shared the question in the group. So check your groups. I've shared the question in the group. So let us try to go through that question and we see. I've shared the questions in the groups. So check. Catherine, you can take the question on your WhatsApp. I'll share the question. Christine and the team, I shared the questions here. So if you have the notes, you'll see this question in your notes. So I'm going to do this. Opio, Opiso were in partnerships. Sharing profits or losses equally. Sharing profits or losses equally. Their statement of financial position as at 31st December 2016 was as follows. That is the statement of financial position for the two partners. Okay. So that is the statement of financial position for the two. For the two partners, they have non-current assets, the building, the machinery, the delivery funds, investments. So these are their non-current assets, as you can see. Okay. So the non-current assets as well as the current assets. Then now we have capital and liabilities. So you see they have capital accounts, they have unappropriated profits, then they also have some current accounts, and you see Opiso has a negative current account. We talked about that in our liabilities, non-current liabilities. We have a 10% back loan, we have a 5% loan. Current liabilities account stable. So that's the statement of financial position for these two partners. We have some additional information. Opiso retired and Opito was admitted on 31st December 2015. So you have retirement, and then at the same time you also have admission of a new partner. You also have admission of new one. You also have admission of a new partner. To determine the amount due to Opiso, assets were revalued. Assets will be revalued whenever a new partner is retiring, or whenever there is a change in the profit or loss sharing ratios. Now, those doing CPA, Yvonne, Annette, Ian, you can check in the revision kit under the questions for partnerships. This number is there. I included it in my revision kit. I don't know the page number. But take, you will see that question under in the revision kit, that question is there. So check in your kit, in the partnership questions, you'll see that question of Opio, PISO. So Opio retired and Opito was admitted. So the assets were revalued, as you can see. Buildings were revalued, machinery was revalued, delivery vans were revalued, investments were revalued, inventory was revalued. Then the value of goodwill was upgraded at shilling 6 million. Now you see, initially there was no goodwill, as you see in the balance sheet, there was no goodwill. But because they are admitting a new partner and an old partner is retiring, now they have to introduce goodwill. They have to account for goodwill, so they introduce goodwill and they value it at 6 million. It was arranged that Opiso takes over the investments at shilling 6 million as part of the payment of the amount in him, and the balance be settled in cash. Opiso was to take his portion of unappropriated profits, and the balance to be maintained in the books. Okay. Opio was to contribute shillings 30 millions. Opio was to increase his capital by contributing shillings 2 millions. Opito was to contribute shillings 30 million as his capital, and the profit or loss was to be shared on the basis of the capital contribution of each partner. The partnership uses the memorandum revaluation method to record goodwill in the books of accounts. We have talked about that method up here. Memorandum revaluation method, we talked about this. That goodwill is, the goodwill account is opened. We share goodwill, but now goodwill will be written off. It's not going to be maintained in the partnership business. So that is the method which we are going to use here. We are going to see how to do that. How to use the memorandum revaluation method. Required, prepare the following for the partnership as at the 1st December 2016. Capital accounts, columnar format, current accounts, then the revaluation account, and then the opening statement of financial position for OPO and OPITO. Now, those with the notes, you'll see that the solutions are there in those notes, but we need to work these out together. Now, this is our question. We see assets were revalued. Okay, assets have been revalued. Assets have been revalued. Assets have been revalued. Assets have been revalued. Whenever you see assets being revalued, what you have to do, you will have to open up a revaluation account first. You have to open up a revaluation. You have to open up a revaluation account first. Whenever assets are revalued, always come up with the revaluation account. So in your books, you should be having a ruler, a pen, calculator. So we need to open up a revaluation account. Yes, you see they are asking for the capital account and the current accounts, but first come up with the revaluation account. Why? Because you need that account. There is some information which you have to take to the other account. So what I'm going to do, alternatively, I can prepare all the accounts here one by one. Okay, the first account is to prepare the partner's capital account, so we can prepare that first. Partners capital. So members, who is using, they, they need to close such that we can continue. Okay, members, we can let us come up with the partner's capital account. I have details. I have details here. Members, do you hear me? Hello?
Yes, sir, you're
Hello.
audible.
Okay. So this is our partners capital account. This is what we have. We have the different partners, details, OPO, OPISO, OPITO. Now we have three partners. Initially there were two, but we have admitted another partner. So meaning that your account has to show three different partners. That's OPO, OPISO, and OPITO. So come up with these accounts, come up with these the partners capital accounts. So the amounts are in shillings. You put the shillings. Let's put the shillings. Let's put the shillings. So we are going to start with the balances. We are going to start with the balances. The balances are brought down. Let's start with the balances brought down. Capital has a credit balance. Capital has a credit balance. So let us enter the balances brought down. Read for me the balances brought down from the question. Balances brought down for OPO is how much? Capital
28,000. Okay, 28 million.
how much is the capital for OPO members? Capital for
Twen-
OPO is how much?
28 million.
28 million.
OPO is 28 millions. Then OPISO
25 million 500.
25 100. Then OPITO, I'll just put there is nothing for OPITO because OPITO was just admitted. So there is no balance for OPITO. So this is partners capital account. Let us also prepare the current account. There is just draft that we're going to come and complete, and then we see what to add in there. This is partners current account. This will be partners current account. This will be the partners current account. How much is the current account for PO? How much is the current account for PO? For PO, it's how much current account? It's negative, eh?
500,000. Yeah, it's a negative.
So it's a debit for PO. That is 500,000.
Excuse me, sir.
Yes, please.
The other figure for PISO is the 25,500.
25,500, eh? Not 25,800, eh?
Yes.
Okay. This is officer current account is how much? That's 4,200,000. Okay.
4,250,000.
Okay, that is photo PPT. That is our current account so far. I've just entered the balance. I've prepared the account. Just enter the balances, but we have to find out more what will be entered in there. I need to come up with a revaluation account as well. You give them spaces because we have more transactions, more details enter in here. So they also want you to come up with a revaluation account. Let us come up with a revaluation account. This is our revaluation account. This is our revaluation account. We have a debit as well as our credit. The amounts are in shillings. So this is our revaluation account. What does the revaluation account record? The revaluation account records the increases or losses in the value of assets as a result of revaluation. So what we do, we have to check out those assets that were revalued. Let me prepare accounts here. These are workings. We are going to come up with the asset accounts. Come up with asset accounts. So asset accounts, let us come up with the asset accounts. Now you have to prepare accounts for the assets that were revalued. Which assets were revalued in this case? Which assets were revalued? What are those assets that were revalued, members? What are the assets that were revalued?
Buildings, machinery, and tools.
So the buildings were revalued. So you come up with a buildings account. We come up with a buildings account. You have to prepare accounts for those assets that were revalued. So this is buildings. This is our buildings account. We want to see what happened on revaluation. Was there a revaluation gain or a revaluation loss? So buildings are assets, so they have a normal debit balance brought down. So buildings are assets. So you start with the balance brought down. How much is the balance brought down from the balance sheet?
50 million.
That is 50 millions. So balance brought down, that's 50 millions. We debit that. But then these buildings were revalued, right? The buildings were revalued. They are revalued how much?
55,500,000.
55,500. So that is now a balance carried down. We call that a balance carried down. That is a balance carried down. We take it on the opposite side. You've said it's 50 what? 55.5. 55.5. 55.5. Now, in this case, what do we have? Do we have a revaluation gain or it's a revaluation loss? Is it a revaluation gain, members, or it's a revaluation loss?
It's valuation gain.
Revaluation gain, sir.
The revaluation gain. So we come here, we write a revaluation. This is to be taken in the revaluation account. How much is the gain? The gain will be 5.5. The 5.5 minus the 50, giving us 5.5. This 5.5 is what we take to the revaluation account. This is what we take to the revaluation account. So this is what you take the revaluation account. This gain of 5.5, you go and you debit it in the revaluation account. So here we have buildings that have been revalued. So you write buildings, buildings. They have been revalued by how much? They have been revalued by upwards by 5.5. So it's there. What else was revalued? What else has been revalued, members?
Machinery and tools.
Machinery and tools. Machinery and tools have been revalued. How much is the balance broke down for the machinery?
$30,500,000.
Brought down of machinery is 30.5. Then the revalued amount is how much?
28 million.
28 millions. That's the revalued amount, 28 millions. So what do we have here? A gain or a loss?
It's a loss.
It's a loss, sir.
Sorry, this gain should be this. This gain should be here. This gain should be here. Look at the buildings account. This should be here. The revaluation, the balancing figure should be on the debit, please, because it's a gain. We increase the value of the asset. Should it be this? Remove that. It should be here. It should be to the credit. It should be this side. It should be this side because it's a gain. The gain will be debited credit account. So this is supposed to be credited. It should be credited. Then the machinery tools account, it's a loss. It's a loss, 30.5 minus. How much is the balance carried down? You said it's 28 millions.
Yes, sir. It's 28 million.
So the totals should be 30.5. Our loss is 30.5 minus 28 M, giving us a loss of 2.5. This is the loss on machinery and tools. There was downward revaluation, so that one will be debited. Machinery and tools, it's a loss of 2.5. What else was revalued?
Delivery van.
The delivery vans were also revalued. You prepare an asset account for the revaluation for the delivery vans as well. How much is the balance brought down for the delivery van?
25 million.
It's 25 millions. 25. 25 M. 25 millions. Revalued to how much? 23.75. 23.75. Is it revalued upwards or downwards? Revalued upwards or downwards? It's revalued downwards, right?
Yes.
It's revalued
Downwards.
downwards. It's revalued downwards. This is a revaluation account. The difference is how much? 25 minus 23.75, that is 1,250. Revaluation loss still, delivery van. Delivery van. What else was revalued?
Investments.
Investment.
The investments were also revalued. You have to prepare those accounts for all the assets that were revalued. You said investments were also revalued. Investments account. How much is the balance brought down for the investments?
Five million 550.
111 million.
It's 7 millions, eh?
111 million.
No, it's 5.5 investments. It's 5.50. Revalued how much? Revalued to how much?
6 million.
6 million.
Revalued to 6 millions.
Yes.
So we have a revaluation, what? A revaluation gain or loss?
Gain.
We have a revaluation. We have a revaluation gain of 450. So this will be taken to our revaluation account. These are investments. What else was revalued?
Inventory.
Inventory was also revalued. This is inventory. How much is the balance brought down for the inventories?
3,100,000.
3 million then.
150.
3,150. That is the brought down 3,150. Then the balance carried down is how much?
4,050,000.
4,050,000. 4,050,000. Gain or loss?
It's a gain.
It's a gain. Gain of 900,000, right? Gain of 900, gain of 900,000. Take it the revaluation account. Gain. Inventory. Inventory. Gain of 900,000. So those are the accounts that were revalued. So we have prepared the accounts for those assets that were revalued. And you see, there are 5, 1, 2, 3, 4, 5. There are 5. So we have managed to come up with the different accounts, as you can see. So inventory accounts, we have all these different accounts and we have come up with the gains and losses. You take them in the revaluation account. So the revaluation account records only the gains and losses as a result of assets that have been remarked, that have been reserved. So the results of revaluation, we take them to the revaluation, account. Now we have to find out if there is a gain or loss on revaluation of these assets. If there is a gain or loss, then that gain or loss is going to be shared and taken to the current account because the business maintains a current account. So let's try to see whether we have a loss or a gain. But of course, these are gains. We have a profit on revaluation because when you add this side, the credit side is greater than the debit. The credit side is greater than the debit. So we have a profit of how much? We have a profit of this minus this and that. We have a profit of 3.1, I think. We have a profit of 3 points. We have a profit of 3.1. That's the profit which we have. That profit has to be shared. It has to be shared. The profit has to be, the profit has to be, it has to be shared. Profit has to be shared. That is the balancing figure. You get the total credits minus the total debits. You come up with a profit, which is 3.1, which is 3.1. So this is a profit. We debit it on revaluation. This is a profit of revaluation. And we are going to take it to the current account. Because the partners maintain a current account, they keep a current account. So that's where we're going to take this this profit on revaluation. So it's only OPO, and the OPISO who are sharing this, because OPITO has just been admitted. So OPITO has no share. OPISO has no share in this profit because it's just the new partners. So new partners are not entitled to share of the profit as a result of revaluation. So initially, these two were sharing profits and losses equally. They were sharing profits and losses equally as per the question. So they are going to share that profit as a result of revaluation. They are going to share it equally. So that will be a half times the 3.1. That will be a half times the 3.1. So these are the figures which you have in the notes you have. These are the figures which you have in the notes you have, and this is your revaluation account. That's how we come up with the revaluation account. This account records the gains or losses as a result of asset revaluations. So this is our revaluation account. This is our revaluation account. Members, if you have a question, you can ask. Where do we take the profit shares? To the current account. So go to the current account. You write profit on revaluation. Profit on revaluation. If the capital account was not given, then you use the capital account. But because we have the current account, these profits, we take them to the current. Account. So that is your evaluation account. That's your evaluation account. I've completed my double entry by taking the profit on revaluation on the credit of the partner's current account. Now, there is goodwill in the question. We need to come up with our goodwill account as well. Goodwill account. We have been told that they use the memorandum. They use the memorandum revaluation method. They use the memorandum revaluation. They use the memorandum revaluation method. So let us come up with a goodwill account here. Goodwill account which I'm trying to come up with. This is our Goodwill account. So Goodwill, we debit the Goodwill account with the total value. We debit the Goodwill account, the total value of Goodwill. How much is the value of Goodwill? How much is the value of Goodwill?
6 million.
6 million.
Goodwill is 6 million. That 6 million has to be shared by the all the partners. That is, we debit the Goodwill account with the total value of Goodwill. But I told you that the all the partners have a share this Goodwill, so you debit them. You debit the account with their share. We have one who there is Opio and Opiso. Opio and Opiso. We have to share that Goodwill between these two equally. That Goodwill is how much? That Goodwill is 6 million. So each of them will take a half. Each of them takes a half. So when I debit the Goodwill account, I have to credit the capital account. I have to create a capital account. So I have to go to the capital account of these partners. I'll write Goodwill. Goodwill, Opio is 3M. And then Opiso is also 3M. So I've entered the Goodwill. That is the first key entry you make. But then it has to be written off because we are using the random revaluation method. So you go to the credit, you still credit it, write capital account. So this is a capital account. The corresponding entry is made in the capital account. So we write capital account. So we write Opio and the Opito. Who retired? Who is retiring? Opiso. So we write Opio and Opito. We have to write off this Goodwill by crediting the Goodwill account. How are they sharing? What are the new ratios? Let's check on the new ratios that we see. So the new ratios, they have told you that Opito was to contribute 30 million as this capital, and the profit or loss was to be shared on the basis of the capital contribution of each partner. Now there are two partners. We have two partners. We have Opio . We have Opio and Opito. Capital, we see that Opio had a capital of how much initially? Opio had a capital of 28M initially. Opio had a capital of 28. Look at the question. Opio had 28M. Opio. Then Opito, we have been told that Opito contributed 30M. Then Opio was to contribute his capital, was to increase his capital by contributing extra M, so extra capital. Extra capital, Opio contributed more extra to M. Opito nothing. So here we have a 30 M, and then even here we have 30 M. So I will say that the profit or losses was to be shared on the basis of the capital contribution of each partner. So meaning that the ratio is 1:1 because this is 30M, this is also 30M. So the ratio is 1:1. The ratio is 1:1. So meaning that they are still sharing equally because their capital contribution equally. So we have to write off that goodwill by still sharing that goodwill equally among these two. So it is 6M. And then even here, so times 6. So now you see your goodwill account has no any balance to maintain or carry on in the books. So this is what we call the memorandum revaluation method. You write off the value of goodwill to 0. So there is nothing to maintain in the books. The debit side equals the credit equals the credit side. So there is no any balance to carry on. If it was the other method, of course, there will be a balance of 6M. But now, under the random revaluation method, this is how you write off your goodwill. This is how you write off your goodwill. So there is no any balance to carry. You see, the debit equals to the credit. The debit equals to the credit. So complete your double entry. Go and debit the capital account with Opio 3M and then Opito 3M. Capital account is here. Goodwill. Goodwill. Opio, it's a 3M. And then Opito, because our Opio has left. So here we are using new the new ratios. So
Senior, the screen is sharing
the screen is not shared. Oh,
Yeah.
sorry. Okay, I'll complete a double entry here. This is the capital, this is the goodwill account. This is the goodwill account. I've created the goodwill account with the shares of Opio and Opito, half. Then after this, I had to go to the capital account and complete double entry. Whenever you see that you have goodwill on the debit of the capital account, goodwill on the credit of the capital account, then they are using the memorandum revaluation method to account for goodwill, to account for the goodwill. So that's what we have so far. Christine, I've just seen your message, Christine. Sorry. This is Catherine. That if Opito had less, would he take his? I don't get this. Would he take the higher ratio, Opito? If Opito had less, would he take the higher ratio? Of course, if Opito had less, then it takes a small share. But now their contributions, you see, they are the same. So meaning that they should be sharing everything equal. 1-to-1. So what else do we have now to account for? What else do we have to account for? Let's check and see now. Go and complete double entry in the capital account. Let us look at now the rest of the transactions which we have not accounted for yet. Then we see how to deal with them very fast, and then we finish. Okay. So let me take you back. This is our capital account so far. Let us check and see what we have now. Revaluation of assets. We have seen how to deal with the revaluation of assets. We have accounted for that. We have accounted for the revaluations. Then goodwill. Have you accounted for goodwill? Yes, we have accounted for our goodwill very well. We have accounted for the goodwill very well. What else do we have? Check the additional information. Opiso was to take, it was arranged that Opiso takes over the investment at shilling 6 million as part of the amount due to him. As part of the amount due to him. When this partner is retiring, of course, we have to pay all the amount due to him. He has to go with his money. He has to go with his. He has to go with his money. He has to go with his. He has to go with his money. So Opiso rather, has to go with his money. So it was arranged that Opiso takes over the investments at shilling 6M as part payment of the amount due to him, and the balance be settled in what? And the balance be settled in cash. And the balance be settled in, and the balance be settled in cash. And the balance be settled in cash. So what we can do in this case is taking the investment. Is taking the investment. Is taking the investment at shillings 6M as part of the payment of the amount due to him, and the balance be settled in cash. Officers take his portion of the unappropriated profits, and the balance to be maintained in the books as well. And the balance to be maintained. And the balance to be maintained in the books. Opposed to increase his capital by contributing shillings 2 million. Let us first enter these capital contributions. Then opposed to contribute 30M. So go to your capital account. Show that these partners have contributed some money. They have contributed in more capital. So let us record the capital. Go to the capital account, write bank. Put bank because this money will go through the bank. Or PO, added more to M. PO added more 2 millions. Then Opito introduced 30 millions. Opito introduced 30 millions. Okay. So now what we have to work out next is the what we have to work out next, anything else which is left out? Let me see. Putting our question. We have Opiso was take his portion of the unappropriated profits, and the balance be maintained in the books. His portion of the unappropriated profits will be taken, And of course, the balance will be maintained in the books. What you'll do, how much is the unappropriated profits? Unappropriated profits, we have this amount, 26,476.05. We need to share this because one of the partners is leaving. So we have to give him his share. You can take this to the current account because I told that the current account, that's where we show the shares of profits. So, and I can say an appropriated profits. Unappropriated profit share. Appropriate profit share. You share that profit, they are sharing it equally. So this guy has to go with his cash share. That will be a half. How much is the value of the unappropriated profits? Someone tweet for me that value of unappropriated profits. How much? How much is that value of the unappropriated profits? Someone tweet for me that. Members, how much is the unappropriated profit figure? Unappropriated profit, how much do we have, members? Please, let's finish. Let's finish. How much are the unappropriated profits? Checking the question, balance sheet. That is 264. It's 26. 26.
26,476.
476.05, right? 0.05. We have that. Even Opito will also get his share. It's 264. 264. 26476. 476 point 0.05. Point 0.5, giving us that. So that is the unappropriated profit share. So we have entered that also. Then what else do we have? I think now we have to look at these ones. We have to look at now these two paragraphs. I think it is this fact. We have to look at this. It was arranged that Opito takes over the investments at shilling 6 million as part of the payment due to him, and the balance be settled in cash. And the balance be settled in cash. And the balance be settled in cash. So how do we deal with that? Let's come maybe let us go to the partner's capital account. You see this guy Opiso has some money here. Opiso has some money on the capital account. He has some good money. He has a 25.5. He has a 3 million for Goodwill. So they are telling us that we are going to give him the investments. So we are going to come and debit the capital account with investments because he's going to take the investments. So we reduce his capital account with investments. The investment is worth 6 million. He's taking the investment as part of the payment. Capital account, we are going to give him investments at 6M. What you're going to do, you're going to balance this account very fast because I see we don't have enough time. Let's balance this account very, very fast. We need to finish this. So you add this plus, this gives us 33M. Plus 33M. Then this will give us around 28. This is a 30. You know how to balance an account. This OP, so we have to give him some money. So I'll put bank. Then balance carried down for those other partners who are staying. So to get the balance carried down for PO, just get a 33 minus this 3M, so that gives you 30M. Then OPISO, we don't expect to see any balance because it's leaving. Then for OPITO, it will be the 30 minus the 3, giving us 27M. Then the bank, this guy is going to receive how much? This OPISO is going to receive 28.5 minus the 6M is taking for the investments, that is 22.5. 22.5 will be given as cash. That will be given as cash. Or they can pay him by check. So this is our capital account. These balances are up here, yet they have to be on the same line. Let's add them. It's this. It's this. This was 30M. There was a 30M here. Capital contribution for this new partner who was admitted. 30M. So these are our totals. The balance carried down. This is
But senior,
yes, please.
excuse me,
Yes,
isn't
please.
this 3 million goodwill that we have given Opito belonging to Opiso?
No, that one was what? It's not for Opiso, it's for Opito. But as we are writing off the goodwill, we use the new shares. Remember, Opiso has left. So as we are using the new shares, we don't consider him.
Yes.
Yeah, we don't consider him. So that is your partner's capital account. That's our partner's capital. That's our partner's capital account. So that is the account, partner's capital account. So for those partners who are existing, the partners who are remaining, their capital account will be having a balance brought down. So this is what they will start with. at the start of the next period. Opio has a 30, then Opito has a 27. That is the partner's capital account. Balance of this, then we go to the current, we balance it, and then we see what next. Just need like some extra 20 minutes, and then we finish this number. So let's finish up. Balance, for those who are still balancing. Let's balance up. Let's balance up the current account as well. Let's balance up the current account. Current account, what do we have there? There is nothing much. Our opening balances are there, the profit shares are there, revaluation shares are there. So let's balance this. Add up. Opito has no any share. It's just a new partner who has just joined. He has no any share of profit so far. So this plus this. Here there is a 0, there is nothing. Yeah. So will get some money on retirement. As by the current account. Balance current down. So Opiso this. Opito 0. Opiso is going to get this money on retirement. The money as per the current account, because they say that he has to take all his money. So he has to go with all this money. He has to go with his money. This was 13. He has to go with all this money. This is a photo. Then 13. Okay, he has to go with the money, all this money. So let's try to do the additions, and we see the balance brought down was 4.2. 4.25, then followed by the profit share. That was 1.5. Then the unappropriated profit. Unappropriated profit was it? And there's a question I shared in the group. Someone to check for me. That question paper, and we see the unappropriated profit. This is 26,476,050. This is supposed to be 26,476,050. As per the question I shared because that's the original question, the one I shared in the group today. So you need to change the figure in the book to the profit figure, the annual profit figure. So PISO will get this amount on retirement. PO will be having a balance. PISO has no any balance on the current account. So we need to get our totals. So the only partner who has a balance as per the current account is OPO with a balance of 14288.025. So that is your current account. That's our current account for the partners. That's our current account for this partnership business. That's the partnership account. Now, they also want you to come up with an opening balance sheet. I think we can do that opening balance sheet. And then we call it a session. We can do it. It will take like just a few minutes. The opening balance sheet, we can do it very fast here, such that we go in this number is complete. So that will be OPO and who? And OPITO. These are the partners now. OP and OPITO. They called it OPO and OPITO. Opening statement of financial position. Opening statement of financial position. Opening statement of financial position. Our amounts in shillings. And do this statement very fast. The opening balance sheet for those partners now, the two. This is what they will be having. Let's do this. So you have the non-current assets. So who is reading for us the non-current assets? Who is reading for us the non-current assets? Ian, read for us the non-current assets very fast.
We have buildings.
We have the buildings.
At 55,500,000.
We take the new values, right? 55.5. 55.5. Then what else do we have?
We have machinery and tools.
We have the machinery. We have the machinery and tools. How much?
At 28 million.
Machinery and tools, we have 28 millions. That's the revalued amount, eh?
Yes.
When assets are revalued, we use the revalued amount now.
We have delivery van.
We have the delivery vans.
At 23,750,000.
The delivery vans at
23 3,750,000.
750,000. What
Yeah.
else do we have?
We have investments.
The investments, eh?
Yes.
They were valued how much? What was their new value?
At 6 million.
6 what?
6 million.
No, if you are valued, yes, 6 millions, eh? Okay, the millions. Anyway, let me just put 0 investments. Do you know why? Because OPISO has taken all of them, right? As part of the payment. Not so. Not so.
Yes.
He has taken them as part of the payment. So now there is nothing like investment here. He has taken them. Then what else do we have?
We also have inventories.
What about the delivery van?
The delivery van, it is at 23,750.
Oh, we have it.
We already have it.
Let me first add this. That is 107,250. Let's go to the current assets.
My current assets, we have inventories.
Inventory, how much?
Inventory at 4,050,000.
4,050,000. What else do we have under the current assets? We have accounts receivable
at 2,250,500.
Accounts receivable at 2 what? 2 million what?
2,250,500.
500. Then what else do we have?
We have bank.
We have bank, but I think we need to come up with a bank account because we have some details about the bank. Money has been paid, money has been received. Let me just come up with a bank account here very fast. And then we see what happened in the different transactions in the business's bank account. Let me just use this bank account. This is a quick bank account. What was the opening balance?
It was 2,250,000.
Opening balance, eh?
Yes.
And current assets still. Balance brought down for bank. Balance was how much? Bank? 35 million.
That's 2,250,000.
The opening balance, Ian, in the trial balance.
Opening balance.
Yes, let us try to come up with a bank.
On bank it is 35.
35.
450. 550.
550. Then in the capital account, some partners contributed more capital. Capital account. The partnership received some money. Capital account.
Of 2 million.
We see OPO. OPO contributed some Opio. Samka to M.
Computer.
Then even who else contributed? Oh, this is who? Opiso. No, Opito also contributed some 30, is it 30 millions? 30. The 30 million was supposed to be somewhere here. Bank, but not here. It's 30. So that's 30 M, we have it. That paid in by Opito as a capital contribution.